Let's talk about the government and the economy. It's a really complex and complicated issue, which we're going to try our very best to keep as simple as possible. We're going to look at some general ideas and concepts that involve the Federal Reserve and the United States government. Hopefully, after these lessons are complete, you'll know a little bit more about the economy and be able to do well on the questions you're going to be asked on the graduation test. Okay, well, let's start with the economy itself. What is the economy? And basically, it's a measure of business in the United States. It's a measure of goods and services that are produced. When the economy is going up, the country is doing well. People are working, people are buying, people are selling, business is good. When the economy goes down, the exact opposite is true. People aren't working, people aren't producing, people aren't buying, and people aren't selling. So the economy, if we look at a graph like this, gives us an indication of how the country's doing overall in terms of its economics. You can see over time the economy goes in sometimes way up and way down. What we would like to see is consistency. We want to get rid of these big jumps that are too high, as well as the big dips that are too low. And that's one of the roles of the Federal Reserve that we're going to start looking at next. So what drives the economy up is spending, an increase in demand for goods. Those are the things that drive the market. The more demand for goods there are, the more goods that are going to be produced, the more jobs that are going to be created, the more wages people are going to earn, the more spending they're going to be able to do. What drives the market down is just the opposite. A lack of demand, a lack of spending, those drive the market down low. If it goes too low, it's what's called a recession. And if that recession lasts a long time, we call that a depression. We'll get to that a little bit later. Well, the first thing we want to look at is the Federal Reserve itself, which was created in 1913. If you look at the history of banking in the United States, it's pretty complicated and actually kind of interesting. From the very early days of the United States, Alexander Hamilton had proposed that the United States have a national bank. And there was a lot of fighting against that, but we did have a national bank, actually two of them, very early on in the country's history. Those banks were essentially not renewed or destroyed, if you will, by President Andrew Jackson, who had a real big problem with America having a centralized national bank. Fast forward to the late 1800s, early 1900s, as America was going through its Industrial Revolution and its industrial explosion, banking became a hugely important thing. There was no guarantee that if you put your money in the bank that it would be there when you needed it. So we needed something that would be regulating our banking system and provide our economy with some structure. And that's how we ended up with the Federal Reserve. It was created in 1913 by the Federal Reserve Act. And the main purpose of the Federal Reserve was essentially to implement the U.S. monetary policy. Basically run our country's money and do what it could do to monitor business and what was going on in terms of our money and our wealth. Their job is to essentially regulate the U.S. economy. We don't want to go too high too fast, nor do we want to go too low too fast. The idea behind the Fed is that it provides stability to the American economy, promote growth, and to create economic success. And sometimes they do that pretty well, sometimes not so much. It's a really hard thing to predict and control. So what are some things that the Federal Reserve does? Well, in a very simple way, the Federal Reserve is really the government's bank as well as the bank's bank. And what I mean by that is the government gets its money from the Federal Reserve. If you've ever looked closely at your money, it says on there a Federal Reserve note. The money is printed by the Federal Reserve. They then sell that money essentially to the government in what's called an open market operation. The government will sell Treasury securities to the Federal Reserve, which in turn gives the government its money. And that's a really complex thing to explain. So we're just going to keep it as simple as possible for right now. The government gets its money from the Federal Reserve. The next thing that the Federal Reserve does is it's actually the bank's bank. So privately owned banks like KeyBank or Citizens Bank can also go to the Federal Reserve and borrow money. That's really important because those banks need that money in order to loan out to people. Banking is a really complex thing if you've never really looked into it or studied it before. But again, our goal here is simplicity. We're not going to dive into the deep economics of banking. We're just going to kind of look at the big picture. The Federal Reserve provides those loans to banks like KeyBank and Citizens Bank, but they also do two very important things that we're going to look at next, which is create what's called the discount rate and the reserve rate. So let's start with the reserve rate. If there's a bank that has, let's say, $100 million in deposits, meaning that the people in that community have deposited $100 million into that bank. The Federal Reserve basically says that that bank has to keep 10% of that money in reserve. Long story short, if you deposit your money in the bank, you know that it doesn't stay there. The bank uses your money to invest. The bank uses your money to loan out to other people. Your money goes to work for the bank and essentially for the community and the economy as a whole. But to make sure that the bank has enough money on hand in case people do want to withdraw that money, the Federal Reserve requires that they keep a reserve. In this scenario, the reserve rate is 10%. So 10% of that $100 million has to be kept by the bank to be available to the people that have deposited it. So in this case, 10% would be $10 million. That means that the bank then has $90 million that it is free to loan out. If the reserve rate were to be 20%, then they would have to keep $20 million essentially in cash while being only able to loan out $80 million. So the reserve rate influences the amount of money a bank is able to loan out. The lower the reserve rate, the more money available to make loans. The higher the reserve rate, the more money the bank has to keep, therefore the less money they can loan out. And that can have a real big impact on the economy. The second thing that the Federal Reserve does is also set what's called the discount rate. We might know it better as a basic interest rate. So if banks borrow money from the Federal Reserve, the Federal Reserve sets the discount rate, which is the percent of the loan that has to be paid back in interest. When you get a loan for something, you understand you don't just pay back the money that you borrowed. If you're borrowing $100,000 to buy a house from a bank, you also have to pay the bank back that $100,000 with interest. In this scenario, the interest rate or the discount rate is 5%. That's a relatively low rate. That means it's cheaper to borrow money because you don't have to pay back as much. The lower the discount rate, the more money banks will borrow and the more money banks will loan out. The higher the discount rate, the less money banks and individuals will borrow because it's more expensive to pay it back. We'll see this in a little bit more detail in the next couple lessons. But just kind of wrap this up. If the bank borrows money from the Federal Reserve at 5% and they loan it out to Mr. Ramage, they'll do that at probably 5.8 or 6%, meaning that the bank will make some money back in interest payments from me. So the banks use the discount rate to set their own rates for loans. They're not going to make the discount or their interest rate lower than the discount rate because essentially the banks will be losing money. So the bank will set its own rate a little bit higher for the consumer so that they can make and recoup their money so that they can in return pay back the Federal Reserve. So two major functions of the Federal Reserve are to set the discount rates as well as the reserve rate. This will impact the amount of money that will be loaned out from private banks to the country in terms of loans or things like that. The next couple lessons we'll get into a lot more detail on how this works and how the Federal Reserve can influence the economy and make it go up or down depending on what these rates look like.